How's it going, everybody? This is BeatTheBush. Today I'm going to talk about investing for absolute beginners. Now, you could be 18 or just graduated college and you got a job where they offer you a 401k option. Most of the time they just go, here you go, and then there's a bunch of investment options, and then you just pick one of them and then they go, oh, what's the division between this fund and that fund, and then you're left to try and figure it out yourself. There's actually a lot more going on with the fund than you just picking whatever percentage and just leaving it alone. Today I'm going to cover the things they don't actually tell you, but it's very important for you to know the background, the psychology behind it, just so that you are an informed investor and you know what to do when certain events happen. The first thing to know is sometimes if you change companies, they might boot you out of the plan and they might cash you out. When that happens, they actually withhold taxes from it and they send you a check. That's very, very bad if you ever let that happen. You essentially have to open up a new IRA account, put money in there, including the withholding that you don't have anymore, and also the penalty. So let's say it's $10,000 in the 401k account and you got a check for like $6,000. Somehow you have to come out with another $4,000 and put it in an IRA. That might be really hard for someone just starting to invest. So if you ever change companies and they kind of warn you they're going to close your account, be very certain to roll it over as soon as possible, because if you forget or fail to do it in time, they will cash you out and you're going to end up having to pay a lot of upfront money in order to avoid any penalties. These company 401k plans usually have a lot of different funds that you can pick from. Generally, I've seen anywhere from 10 to 20 or 30 funds. It's usually these target date funds. Sometimes they do have low expense ratio ETF funds for the indexes or whatnot, but this really depends on the plan that you have. If you're just beginning to invest and you got a total portfolio of maybe $0 to $20,000, let's say, the expense ratio is not going to be that bad on your total portfolio, especially in the beginning, because you don't have that much to compound yet. So you shouldn't be too worried about the expense ratio, but just keep note of that. Whenever you have the chance to get a lower expense ratio, do it. If you're stuck in a plan that has high expense ratios, don't freak out or anything. Just let it invest. If you ever change job, just roll it into an IRA, and then at which point you can buy the low cost index funds that you like. A typical novice thing to do would be to time the market. Now, I've done this myself. I've tried to buy and sell a fund. You essentially buy one fund within that 401k plan, and then as soon as you sell it, you actually cannot buy back into it for 30 days. So what I actually did before was I just buy a different fund, because I know several of those funds would actually move with the market. So I'm just trying to time the market. I know you're not supposed to do that, but that's what I did. I had okay success with it. I wouldn't say I beat the market or anything, but it was just something I was experimenting with. So a lot of studies have been done saying you shouldn't try to time the market. You're essentially gambling when you try to time the market. Maybe if you have some really, really good insights, or maybe you get lucky, then you can outperform the market. But the thing to note is it's really hard to outperform the market for a long duration of period. So if you ever try to time the market for, let's say, 5 years, maybe you would get really lucky the first 2-3 years. Oh, maybe you made like 20%, which is something I actually was able to do for like a year. But when I sold out of the market, I didn't get back in. I actually didn't get all the gains that the market was also getting. So then it kind of averages out. Maybe I even lost a little bit as compared to if you just put the money in and just kept on investing. If you just stay steady and true and just keep on investing, most likely you would get better returns than most people. The whole idea with this investing is to dollar cost average. So as you're working, you're always investing a little bit in there every single month. I'd say the most important thing of this investing business is not to freak out if the market ever crashes. It's much harder than you think it is if you've never experienced a market crash before. I've seen the 2001 and the 2008 crash where I saw the whole market go down by 50%. You see it unfold before your eyes. Let's say you had $10,000 in there. One day it drops 10%. It goes down from $10,000 to $9,000. You go, oh my gosh, that's $1,000. That's like, you know, how many weeks of pay that is. And then the week after, drop another 1,000, and then the week after, drop another 1,000, and then by the time maybe 5 or 6 months, you saw your portfolio go from $10,000 to $5,000. You know, this will make most investors very, very scared. So why am I telling you this? Because you really have to be mentally prepared for your portfolio to go down by a lot and just keep on investing. So you just do a mental exercise. What if your portfolio goes down by 50%, what are you going to do? Are you going to be the type that would just sell some so that maybe you won't take any more losses? Or are you just going to keep on going and just invest some more? And when you invest some more, it's going to be at the low cost. So it's actually really good for your total portfolio. There has been a lot of blogs out there saying, oh yeah, you should completely put all your cash into low-cost ETF funds that are the indexes of S&P or something. The deal with this is that it's okay to do that if you plan to retire in 30 years. With a lot of people saying, oh yeah, I'm gonna retire really early, then if your time frame is actually 10 years, you may not have the time frame to fully invest in a S&P 500 index fund because it's very volatile and you could get caught in a point where the market dips a lot and by the time you retire, it hasn't fully recovered and it hasn't gotten gains. So most financial advisors would recommend for you to get less and less aggressive as you get towards retirement. Because if you're a year or two within retirement, then you don't want your portfolio to fluctuate by that much. You kind of want that to be a sure thing. However, if you are somehow really flexible, if you say, oh, I'm going to retire 10 years, or 15 years, I don't care. It doesn't matter too much if the market goes down a little bit. I can delay my retirement by 5 years, by 10 years. 5 or 10 more years in delaying your retirement is actually a lot. And I think most people that have a target is not willing, if they can help it, to extend their retirement by that much more. So if you do plan to retire in 10 years, you have to pick a target date fund. Today is 2017. If you plan to retire 10 years from now, which is 2027, then you need to pick a target fund date of 2027, which would actually get you less gains per year. Mainly because it's a lot more conservative and it's not fully invested in large cap stocks and things like that that are more volatile. So that's all for today. I hope this gives you a little bearing around what you should do with a portfolio. It's not just as simple as, oh, just picking one target date fund, because at some point you might be very, very tempted to just sell all of it out and go, oh, I'm just gonna take the cash and run from the market and not invest anymore. Don't forget to give me a like on this video, comment down below. Let me know if you already know about all this already. If you're interested in supporting this channel, I have an Audible link down in the video description below where you can actually get a free audiobook. And if you cancel before the trial period ends, you can still keep the audiobook and you can still help benefit this channel. I also have a Patreon link over here and don't forget to subscribe. Thanks for watching.